The art of the exit. November 2021, Bitcoin hits $69,000. ETH nearly hits 4,900. Crypto market cap is now $3 trillion. 12 months later, over $2 trillion wiped out. Three Arrows Capital collapsed in June. Voyager and Celsius filed bankruptcy in July. By the end of the year, FTX went bankrupt. Normal people watch their portfolios go from generational wealth to underwater. This video is a framework to help investors think about how to take chips off the table, how to study exits, why different assets need different approaches, and ultimately, what do you do with your cash when you've taken your money out? To do this, we're going to cover 5 different indicators that highly effective investors use when making exiting decisions. Individually, they can be unreliable, but together, they paint a much clearer picture on the art of exiting. Look, indicators don't call tops, but they do help investors understand conditions. And once you understand conditions, you'll be able to figure out where we are in the market cycle. And understanding that is step 1 in formulating a plan to exit. Let's get into it. Indicator 1, funding rates. The crypto futures market is dominated by perpetual contracts. Unlike traditional futures, in crypto, futures don't expire. The mechanism that keeps the perpetual price in line with the actual price is called the funding rate. It's a small payment made between traders. When the crowd is heavily long and leveraged, longs pay shorts. When the opposite is happening and people are heavily short, shorts pay longs. So by looking at funding rates, we get a very good idea of what traders think is going to happen next. If they're super long, they think bullish. If they're very short, bearish. As a cycle tops, funding is positive and stays elevated for weeks. Everyone is leveraged long. Everyone is paying a premium to stay in the game. The issue is one bad piece of news or data, and we can see a huge number of cascades that sends the market crashing. On to indicator 2. Indicator 2, MVRV, also known as market value over realized value. In simple terms, it measures whether holders are up or they're down. Are they in a paper profit or a paper loss? People up 5x are usually itchy to sell. People underwater are often frozen with fear. When paper profits reach extreme highs, we usually see the cycle top or very close to the top, because at that point, the average holder is no longer buying. They're thinking about when to start cashing out. They're looking for exits. And of course, the same works in reverse. When holders are sitting in deep losses, most people have already sold. These people don't want to exit now at a loss. Indicator 3, the pie cycle. This is a very simple chart that shows moving averages. When the shorter one crosses the longer one, it has historically marked the Bitcoin top. It fired in 2013, it fired in 2017, it fired in April 2021. However, and here's the lesson I need you to absorb, in November 2021, Bitcoin hit an all-time high and the pie cycle didn't hit. Anyone trusting that single indicator was caught offside. The pie cycle is one of the most respected indicators in all of crypto. And if you looked at that indicator alone, you would have lost out. This is why you can't rely on single indicators. Indicator 4, Bitcoin dominance. This is Bitcoin's total share of the crypto market cap. When dominance is rising, money is consolidating into Bitcoin. When it's falling, the opposite is true. Money is leaving, oftentimes into alts. Late in every cycle, the same pattern plays out. Capital rotates from Bitcoin to large caps, and then from large caps to mid caps, and then from mid caps to small caps. People, as the cycle progresses, slowly move up the risk curve. By the time retail is rushing in and Bitcoin dominance is at a low, this is usually a sign things are too late. Last but not least, indicator 5 is retail sentiment. I'm talking about Google search volumes, how crypto exchanges are ranking on apps, and what your friends are talking about at the pub. When an Uber driver starts giving you tips on what tokens to buy, probably a sign things are heating up and it's time to get out. Ultimately, as they say, What goes up must come down. When peak interest arrives, it inevitably starts to drop. Those are the big five: funding rates, MVRV, Bitcoin dominance, retail engagement, and the pi cycle. Now let's piece it all together. These indicators are not predictive, but they are confirmatory. Think about all of this like leaving a party. No one can tell you when the party is at its peak. There's no single announcement that this is the high of the night. The energy just gradually changes. The people who stay until 4 a.m. suddenly realize that the room's empty, and the people who left at 11 p.m. feel like they missed out. The people who actually manage the night well don't make some sort of perfect exit. They leave when the signs start to show. Friends leave, energy drops, yawning begins. They know how to read the room, and the same thing is true for a crypto investor. So what does the framework actually look like? A common practice is to exit at multiple price levels or specific time intervals. These need to be pre-committed and executed automatically. We call these ladders for short. There are three popular structures that most serious investors follow. As we said, price-based levels. The position is divided across different portions, and you agree to sell at specific price levels. This could be 2x, 3x, 4x your cost basis, and regardless of where price moves, that's when you get out. The specific levels aren't predictions or recommendations, but they do illustrate pre-commitment to exiting. This reduces the need for a perfect exit. Then we have time-based ladders. The position is now once again divided into portions, and the investor sells in a calendar regardless of price. And of course, the third option, which I personally use and most serious investors use, is to combine both of them. For me, I am price-based primary with time-based safeguards. Combining the two is the best way you can set yourself up to exit correctly regardless of market conditions. The key here for all of this is discipline. It's all about commitment. In real life, this is what tends to happen, and I've heard this story 1,000 times. The market's calm, you're comfortable, you're confident, and you set a very logical ladder on when to exit. You say, I'm going to exit at 2, 3, and 4x of my cost basis, and I'm going to sell 10% each time. First level hits, you sell 10%. Second level hits, and you sell another 10%. Third level hits, and now you feel like it's moving better than you thought. Maybe you're selling too much. You see what could have been. You say, wow, well, if I didn't take that capital out, how much money would I have had? I felt this myself. And suddenly you decide you're not going to exit. You're going to keep holding, and you see your portfolio grow. But eventually the market turns. It always does. And you look back and you realize, I didn't exit properly. I held on too long, and this is how people round trip. That is the most common failure in the ladder strategy. It's not the ladder itself, it's how you chose to climb the ladder. A simple solution for this is to separate the actual decision from the execution. This can be done very simply by setting limit orders, stop losses, or perhaps handing custody over to someone you trust. The point is not the specific tool. The point is that the choice was already made. Now, let's go one level deeper. Different assets require different exit strategies. A framework that treats Bitcoin and meme coins the same is not a framework. Of course, it's better than nothing, but it's still not good enough, especially when you're dealing with large capital. Bitcoin has a tremendous amount of liquidity. Exiting can be done over several weeks. Small caps, however, face very serious liquidity problems, especially when markets turn red. By the time price confirms that we topped out, there is very rarely enough liquidity in the market for you to exit in a manageable way. You end up spending more money on slippage than you made in the first place. For more speculative plays, the best approach is to typically go with time-based exits. That way you're not latching onto a price that may or may not ever come. And look, ultimately, now you've exited properly. You're out of your assets, you have cash, you did a good job. But what do you do with it now? Ultimately, once you've won, you need to classify your wins into different buckets. Wins need to be reclassified into different liquidity buckets. Some capital may remain in cash for flexibility. Some cash, perhaps you want to put into different investment classes, such as stocks or gold. And perhaps you want to keep some crypto on standby too, some Bitcoin or stablecoins. Worth noting in that case, I kept stablecoins and cash separate because they're not exactly the same thing. Stable coins still require a peg. There are intrinsic risks while holding a stable coin opposed to cash. We saw this with the 2022 UST collapse and the 2023 USDC depeg. Ultimately, the broader principle here is to understand that exiting is just part of the game, and it's not a conclusive part of the game. Exiting is a checkpoint. The game goes on. The key is to sit tight and enjoy the intermission so you can continue playing when the time is right. So that's it. The investors who came out in 2018 and 2022 with capital intact were not those who sold at the perfect time. It was the ones who had a plan, who executed it, and didn't try to outsmart the market on the way up. The framework is not about being right. It's about not getting white. Thanks for watching.